Hi there. My name is Van HESSER. I am the Chief Strategist for Kroll Bond Rating Agency. In our lifetimes, we've never lived through a shock like COVID-19, nearly inconceivable event that hit the world seemingly at once, where the policy response of isolation and lockdown resulted in a synchronized freezing of significant parts of the global economy. Credit investors now find themselves in a phase of the pandemic with powerful cross currents. On one hand, the worst economic news imaginable, while on the other, massive and coordinated monetary and fiscal relief, and all of it complicated by uncertainty around the race to find a cure or treatment protocol for the virus. Making matters more challenging is a wild swing in markets, where we've been mostly risk on since the Fed said it would buy corporate bonds. And we haven't even gotten to the oil shock, US elections, or China-US tensions. So how do you make sense of all this? In our recent report, we identified 4 forces that we believe will shape consumer and commercial sentiment over the near term. 1, don't fight the Fed. Yes, there's an ominous sense of who's going to pay for all this, but it's hard to argue that the federal government has been caught in the headlights in terms of acting to backstop fixed income markets, including unprecedented support of corporate bond and asset-backed markets. And we believe there is more where this came from, which is critical because we believe the US is going to need it. We see this as a positive. 2, movement towards a gradual reopening of the economy. Success in flattening the curve and adapting to the lockdown have been positive developments, but growing frustration among some is a very real phenomenon. In Europe, the varied and slow pace of reopenings in some countries could prove counterproductive, and in the US, public opinion remains decidedly broad reopening. We see this as more of a mixed impact. 3, growing humanitarian crisis. In the US, up to 1/3 of the jobs are vulnerable due to the impacts of COVID-19, with lower income individuals to account for 80% of job losses. Further, with approximately half American households living paycheck to paycheck and without savings equal to 3 months of expenses, getting as much of the relief money to those who need it is critical, and the early read has not been reassuring. We see this as a negative. 4, progress on a cure. Given the global spread of the pandemic, it's hard to imagine that any one thing has attracted a faster call to action than this virus. Each possible breakthrough headline serves as a check on a darker gravitational pull, be it in markets or an individual's psyche. We see this as a positive. So if we pull it all together, we believe that we have reached a relatively constructive phase of the pandemic from an investor's standpoint. Now, it's important to note, however, that all of this hinges on just how successful federal relief and intervention is in holding together the nation's economic and societal fabric through what is forecast to be the worst of the storm, 2020's second quarter. We conclude the report with a bit of a warning. First, we are wary of a second wave of infections that many experts believe could hit in Q4. Second, we have long believed that behavioral scars will slow the economic recovery. There is no V-shape in our forecast. And third, eventually we would expect the debate over budget deficits to reignite. That's for another time. Take a look at the piece. Let me know what you think. You can find all of our research for free on kbra.com. Stay safe.